Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Today's video is all about futures contracts. We're going to learn how to use futures contract as part of every farmer's commodity marketing plan. Shouldn't be using futures contracts for all of your bushels in your marketing plan, but it should be used as a tool. We'll get to that here in a second. So what are the topics today? What is a futures contract? We're going to define what a futures contract is. We're going to look at contract specifications. We're going to look at mechanics of futures contracts, how they trade on Chicago and CME, Chicago Mercantile Exchange, Chicago Board of Trade. I'm going to give some simple examples, and then we're going to talk about the financial obligations, also known as margin money or margin calls. Our first topic today is defining what a futures contract is. The official definition is a commitment to make or accept delivery of a standardized quantity and quality of a product at a specified place and time at a specified price. Simply put, when you're selling your corn bushels at the local elevator, you're determining the price, the basis, where it's going, and so on and so forth. You can do the same thing by shorting futures on Chicago or Chicago Board of Trade. The only difference is you might have some financial obligations or margin calls with that futures contract, as opposed to selling to your local elevator. They take care of that, and the other difference is that your basis remains open. So if your basis narrows, at the end of the day, you may end up getting a better net price. This is exactly the same as a fixed forward contract, except the producer does not have the physical delivery and production risk. So again, it's similar to selling on Chicago, but instead of selling that fixed forward contract to your local elevator, you're using futures contracts. The producer is still open to the cash market and basis I just mentioned. Futures market is a zero-sum game. For every winner is a loser. For every debit is a credit. Each day that happens. Our second topic today is explaining future contract specifications that trade on the CME, Chicago Mercantile Exchange, or the CBOT, Chicago Board of Trade. In some cases, we even trade on the ICE Exchange in Winnipeg. So in our first example, we've got corn. The quality of corn is US number 2. The quantity is 5,000 bushels. Most of the contracts on Chicago Board of Trade trade in the 5,000 bushel contract size. Place of delivery, Chicago, Toledo, St. Louis. Time of delivery, December, March, May, July, September. As you know, there are not contract future months for every month of the year. And then price is negotiated by the parties to the contract. In our second example using canola, the quality is Canada, number 1. Quantity is 20 tons. Place of delivery is a 100-kilometer radius of Saskatoon. Time of delivery is January, March, May, July, September, November. Most farmers use November as their month to sell canola, just after harvest. And the price negotiated by the parties to the contract. Our third topic is explaining the mechanics of futures trading. Futures are traded only on exchanges such as the CME, Chicago Mercantile Exchange, Chicago Board of Trade, or the ICE Exchange on the Winnipeg Commodity Exchange by people licensed to trade them, futures brokers, also known as commodity brokers. The public, the farmer who wants to hedge, or traders, speculators, have to use brokers and open up a commodity trading account in order to do that. Traders of commodity futures include hedgers and speculators. Hedgers are the guys who produce, process, or use commodities and want to reduce their price risk or establish prices for commodities they will trade in the future. Speculators attempt to profit by forecasting price changes. If speculators believe prices will fall, they would initiate a position by obligating to deliver in the future. In other words, the speculator could sell, be short, if they believe prices will fall. If the speculator believes that prices will rise, they would initiate a position by obligating to accept delivery in the future. In other words, a speculator could buy, be long, if they believe prices will rise. Prior to delivery, a seller can buy back, offset their obligation to sell if the prices fall below the agreed upon price. So if the hedger or speculator shorted futures, by the time they deliver that product to the local elevator, they could offset that position by buying back that short position, and in the process they make a profit. On paper, the buyer has lost value, but also has the option to offset and reduce his loss or her loss. Speculators make or lose money from the change in price between taking the initial position, whether being long or short, buy or sell, and offsetting positions at a future date. Our fourth topic today is to give you a few examples using futures contracts. Our first example is using corn. So let's assume in April, December, corn futures is trading around $6.76 a bushel, and the speculator or the hedger, the farmer, feels that prices will fall or go lower by July. The speculator hedger would take a short position, sell futures. The price falls by June 2nd, so the speculator hedger profits by offsetting with a long position at $5 a bushel by buying back that short position. In this process, they've made $1.76 per bushel profit, or about $8,000. It's $1.76 times 5,000 bushels per contract. We talked about that earlier, that contract specification times one contract. If you had two contracts, you just multiply that by 2. If instead the price rises by January 15th, the speculator hedger loses, which means future short position is offset at a higher price at a loss. In this case, we'd have a loss of $1.24 or $6,200 per contract. Again, it's one contract that we are assuming. Let's use another example with canola. On April 19th, canola futures falls from $5.80 a metric ton to $5.60. If a farmer sold on April 19th and bought it back on April 28th, which most farmers would never do, but they might. Typically that's the speculator. They would make a profit of $20 per metric ton. If someone bought canola futures on April 19th and sold on April 28th, they would lose about $20 a metric ton. In the process, the profit or loss is about $400 a contract. It's $20 a metric ton times the 20 metric tons contract size times 1. Our fifth topic and final topic today is to explain financial obligations with futures, also known as margin money or margin calls. Initial margin or bond requirement is a small portion of the value of the futures contract that is required as a bond when a trader takes a position. In other words, the CME, the CBOT, all these exchanges require that the speculator, hedger, usually put up about 5% of the value of the contract. You could literally put up the entire value of the contract and never have another margin call, but that's not the way the business operates. They just allow you to put up 5%. It's a good faith deposit. Its purpose is to guarantee the financial performance obligations of that contract. Both the traders, the long and the short, deposit a margin, usually again that 5%, when a position is opened, whether it's short or long, sell or buy. But the trader who is losing on paper is responsible for maintaining 100% of his or her paper losses. Let's give an example with corn. We used this example earlier. A trader sells December corn futures. He's short. He thinks the price is going to fall at $6.76 per bushel with initial margin requirement of $1,500 per contract. 10 days later, the price increases by US 30 cents per bushel to $7.06 per bushel. Additional margin is required. 30 cents times the 5,000 contract size equals $1,500 per contract. For the trader who was long, the original margin was also $1,500, but there's no additional margin as long as the price doesn't fall below that $6.76 per bushel original entry point. In our next example, using canola, a trader sells November canola futures. Again, he's short, sells at US $5.80 per metric ton with initial margin at $5.80 per contract. 10 days later, the price increases by $20 a metric ton to $600 a metric ton. Additional margin required is 20 times 20, which is $400 per contract. Again, for the trader who is long, the original margin was also $5.80, but there is no additional margin as long as the price doesn't drop below $5.80 a metric ton. So, in summary, knowing the ins and outs of futures contracts and how they operate is essential before opening up a commodity trading account. I have to stress that. This is very important. Make sure you understand how they operate so that you can manage your expectations going forward and there's no surprises. Futures can be used when your cash or physical booking market is not available. Remember, if you're a farmer and you're along a commodity, corn in the ground, canola in the ground, futures should only be used to hedge, not to speculate. So when you're long a commodity in the ground, you're short the futures market on Chicago or CBOT. We will cover hedging with futures in a later video. Thank you for spending some of your valuable time with us today, and we hope that we have shed some light and insight on understanding futures contracts and how they operate. We look forward to seeing you next time.